You should probably buckle up because things are likely to get way worse before they get any better when it comes to buying a house. The national median existing home price just had the biggest year-over-year price decline since January of 2012, falling by just over 1.7% in April from a year ago to $388,800. At the same time, we saw U.S. existing home sales fall for the second straight month in April, down 3.4% to a seasonally adjusted rate of 4.28 million, where most economists were forecasting that home sales would drop to somewhere around 4.3 million. So what we've seen is the number of transactions closing go down. One, due to housing affordability, just less people out there being able to afford these properties. You know, we often talk about willing and able demand. Willing is those that are willing to buy a house, which is most people out there. Most people want to be homeowners. But able demand, those that are able to actually follow through and get the job done. Those that can not only qualify to buy a home, but decide to buy a home. And at the moment, we have less able demand in the market. But the real question here is, should you be worried about the median home price declining? So what this is saying, if you bought your home a year ago in April, you're down nearly 1.7% on the value of your home. Well, the easy answer is no, you shouldn't worry about that for two reasons. One, the median, as far as I'm concerned, is garbage. It's easily influenced. It's a lagging metric. It's often lagging as sales are going up on the low side, and it's often lagging on the high side as prices are coming down. In addition to that, the value of your home only matters if you're trying to sell that property. And for the majority of people out there sitting on super low interest rates, those people aren't thinking about selling their home. In fact, that's probably the biggest problem in the housing market at the moment, is the lack of sellers in the marketplace. Now, I know many people are watching this video going,
Jeb, wait till the recession happens, wait till these people are laid off and are forced to sell their properties. They're going to have to foreclose on them.
Well, that's actually where you're wrong, because Americans are sitting on a tremendous amount of equity. In addition to that, new foreclosures and bankruptcies are essentially sitting at all-time lows. So yes, there's a chance of a recession, which we'll talk about here in a minute. Yes, there's a chance of layoffs, but in all reality, that's not likely to help the housing market in any way. Now, at the moment, there's a couple of other things playing in the macro view of the economy that could have an effect on housing. One, interest rates. Two, the Fed. And three, the potential of us actually defaulting on the US debt. Before we dive into that though, I would like to take a minute and ask a favor. If you find any value in the videos that I do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to stay updated on everything real estate related. So one of the main reasons we're in the situation that we are at the moment is the unintended consequences that we have from the Fed lowering interest rates to all-time lows during the pandemic. Because essentially what that did is it locked sellers into homes. At the time, it seemed like a really good idea. Instead of handing out a bunch of checks, what they would do is lower interest rates and allow homeowners to refinance their mortgage, essentially bringing their mortgage down $300, $400, $500 per month. So instead of giving them a monthly check, what they did was brought rates lower and in turn save homeowners $300, $400, $500 every single month for the life of that loan. But in turn, what that did is it is now locked sellers into homes. Because interest rates have doubled since that period of time, home prices have continued to go up. And now we've created a world where no one wants to sell their home because of how expensive it is to buy the next home. But one thing that is likely to help with housing in the future is interest rates. But it's not likely to help in the way that it did a couple of years ago because we're not likely to see interest rates that low. But as we start to see interest rates trend lower, we're likely to see some sellers come off the fence. But here's the thing, we've been talking about interest rates dropping as inflation drops. And we've seen inflation come down from nearly 9.1% last June to where we're sitting today at 4.9%. So even though we've seen inflation come down, we haven't really seen interest rates come down. And as much as I believe interest rates are going to come down, I think they're likely to stay somewhere in that mid-5 to mid-6 range for quite some time. In fact, we're seeing interest rates bounce all over the place, which is exactly what's happening right now. We've seen mortgage apps decrease as interest rates push back towards 7%. And that's largely because mortgage demand also dropped because interest rates are sitting near 2-month highs. So what could get the Fed to actually pause, to pivot? A lot of people out there believe that the May meeting was the last Fed hike that we'll see in 2023. In fact, there are people out there already pricing in price cuts with regards to the Fed funds rate for later in 2023. Now, I don't necessarily see rate cuts coming unless we see the economy get into a much worse state. At the moment, we've got some mixed data out there, which essentially supports the Fed's thought process that inflation hasn't really moderated enough and that the economy remains strong. Just a couple of weeks ago, we got weekly U.S. jobless claims hitting the highest number since 2021. So it looked like employment was getting worse. In addition to seeing consumer debt pass the $17 trillion mark, on top of seeing retail sales come in less than expected as consumers struggle with inflation. And then all of a sudden this past week, we see that U.S. jobless claims tumbled, actually coming in less than expected, on top of there being quote unquote fraud with some of the numbers from the previous week. So when they reported the previous week saying that the numbers were at all-time highs, well, I guess Massachusetts had actually reported the numbers incorrectly in some way. Therefore, the numbers weren't quite as bad as they had originally thought. On top of that, you have home builder sentiment pulling out of negative territory for the first time in nearly a year. And that's largely due to the lack of inventory out there, which is pushing more buyers into new construction, and in turn, improving the sentiment of builders. With that said, the share of builders reducing their prices dropped to 27% in May. That's down from 30% in April, 31% in February, and down from nearly 36% last November. In addition to that, you have less builders out there having to offer incentives as more buyers get pushed to new construction. And that's why you have the Fed's Bostic casting doubt that there will actually be rate cuts this year, in addition to Dallas Fed President Logan saying that the current data doesn't justify pausing rates just yet. But here's one thing we do know. We do know that the Fed does not stay at the peak very long when it comes to hiking the Fed funds rate. In fact, as you can see from this chart here, you see that the Fed doesn't stay at the peak for longer than just a couple of weeks on average, which likely means as the Fed starts to admit that we're headed into a recession, that we're already in a recession, that they're likely to back off their super hawkish stance, which will allow interest rates to come down even more. But let's take a minute here and talk about the elephant in the room, which is the U.S. debt ceiling. At the moment, you have Janet Yellen saying that we could see a default as early as June 1st. In addition to that, you have headlines coming from Zillow saying that a default would lead to interest rates above 8%, on top of home sales plummeting, in addition to the housing market slipping back into a deep freeze. But let's all be honest here. The likelihood the U.S. defaulting on their debt is very, very low. Even if they do, it's likely only to be for a day or two, which in all reality means that most of us have absolutely nothing to worry about. The whole talk around the U.S. debt ceiling is a political stunt, and therefore, in my opinion, will have very, very little impact, if any at all, on the housing market. So here's the thing. If you're a home buyer out there in the current market, you need to be prepared to move quickly due to low supply because of the mortgage rate constraints. Now, this isn't a push to get you to go out and buy a house. It's more of an informative video to let you know what's going on in the housing market. A lot of people want to compare, demand dropping, the number of transactions dropping to 2007. And in fact, the number of transactions that are closing right now are tracking very closely to those numbers back in 2007. So if you're looking at the number of transactions closing, it looks eerily similar. But the biggest difference is back then we had over 10 months of supply of homes, whereas at the moment here we're sitting less than a month in many markets out there. So while I know this is very difficult for people to hear out there because they want to see housing affordability improve, they want to be able to accomplish the American dream, and me as an educator, me as a real estate agent, I would love to help you accomplish that goal. But it's also my goal to tell you exactly what's happening in the housing market. So with that, we're not likely to see any major drops in prices. We're not likely to see any major pickups in the number of transactions, the number of inventory hitting the market. In fact, it's the opposite. We're likely to see kind of a lull in the housing market for the next couple of years. And it's largely due to the lack of inventory out there in the market. Yes, we're likely to see some more inventory come to the market over the next couple of months, but understand, most of that inventory are going to be sellers who are also buyers. Most people don't sell a home and decide to go rent. Most people sell a home and decide to go buy another home, which in turn doesn't create any new inventory. Now, it might allow some new first-time home buyers to get into the market, which will help the number of transactions pick up, but that's not likely to help the majority of people out there. Now, if you're one of those people out there that believe renting is better, there's a Dave Ramsey quote that I really like that I use very, very often, and it's renting is buying you patience until you're ready to buy a home. So there's nothing wrong with renting. In fact, single-family rent growth slowed for the 11th straight month. So you're not seeing the increases that you were over the last couple of years, but here's the key, you're not seeing decreases either. It's not going down, it's just not increasing at the rate that it was. So whether buying a house is the right answer for you or not, that's for you to decide. But if you want to know what's going on in the housing market in more detail, do me a favor and check out this video here.